At the moment, it's striking that calm in the developed markets contrasts with all of these worries we're seeing in emerging markets. Look at the US. All parts of the private sector, domestic demand are doing really well. The economy's full employment, and it looks like the Fed is going to want to raise interest rates in December. Even Japan, Europe, growth there is holding up really well. Core inflation is picking up in both regions. In Japan, inflation's running actually at the fastest pace in about 20 years. We can contrast that with all of the worries about emerging markets. A lot of that comes down to China and the impact that's having on commodity prices, commodity exporters. We think China has tremendous problems, but at the same time they do have policy measures to try to smooth the pace of adjustment, and we expect them to step up the pace of policy support. If you look across the rest of the emerging world, some countries have terrible problems, Brazil, South Africa, but we shouldn't generalize too much. India's doing fine, and even someone like Russia seems to be starting to come through the worst of its problems. So I would say it's wrong to be too negative, it's wrong to generalize. I think it's wrong to talk about a crisis in emerging markets. We need to be more specific about that and focus on the places that do have problems, and remember that most of the developed world is doing just fine.
Despite the Federal Reserve not raising rates in the month of September, markets continued to gyrate on concerns over the impact of weakening emerging market economies on the global economy. The continued volatility seen in emerging market currencies and soft commodity prices were dampening sentiment for global risk asset classes of equities and high-yield bonds. Last month, we said that this recent sell-off is a correction and not the start of a bear market for equities. We continue to hold this view. This is because historically, a prolonged bear market was usually the result of two scenarios: a deep recession-like scenario or a scenario of runaway inflation in which central banks would have to respond by hiking rates quickly and sharply. Today, we do not see such a scenario unfolding. The developed economies of US, Europe and Japan are in recovery mode. Inflation is also well controlled, thus removing any concern of immediate tightening of central bank policies. We continue to advocate overweighting developed market equities, in particular Europe over Asia. We see profit margin improvements in Europe driven by better economic growth as well as continued easy policy by the ECB. We are cognizant that Asian equities have had very poor relative performance in the past few years, and valuations today have approached depressed levels. However, we are not ready to upgrade Asia as yet until we see signs of stabilization in China growth as well as until we have gone past the first rate hike by the Federal Reserve. We recommend to be engaged in risk assets through a neutral weighting in equities. For this month, we changed our overweight stance in emerging market high-yield bonds to neutral, given the ongoing depreciation of emerging market currencies and persistent weakness in oil and commodity prices. We prefer Asia versus Latin American and Brazilian high-yield bonds. We advocate holding an overweight position in cash versus an underweight position in investment-grade bonds in the face of the impending Fed rate hike.